Hey, so I want to look at XLE, the ETF. This is the energy sector right here. Last time we looked at this was about a month ago on May 31st. At that point, it was trading at $76. I noted that for me, I'm interested in buying this one at 61 with resistance at 91. We also noted a couple things. It looks like average yearly return is 3.5%. That's just based on average, based on a trend line that we picked out. We noticed it broke the shorter uptrend, but the long-term uptrend is still intact. So what I want to do is first go over some news, just what I've seen written up about this ETF here, and then we'll go into the technical analysis and just see if any of these numbers change, the 76, the 61, or the 91. We'll see if that fluctuates at all. So let's just start off with the news here and just carry through. Okay, so XLE here. Um, so just to start off, whenever we're going through these, just pay attention to the article dates. And because it's been a little while, we might flip through, like go back and forth between looking at the technical chart and going over the news. But this article just starts off by saying the EIA's recently released weekly petroleum status report showed declining demand for gasoline and jet fuel in the week ending April 28th. Further China reopening is expected to be a positive for oil. The demand hasn't been linear. China's factory activity unexpectedly cooled in April, reducing demand expectations. So not so good in terms of they thought it would come back quicker. I think the April thing, correct me if I'm wrong, but I think that's Chinese New Year. I think that's kind of what happened there. Uh, but to wrap up this article, I think from the demand side perspective, the Chinese story from an industrial capacity perspective is still to play out throughout the year. And that's from the CFO of BP. So they still believe China's economy will pick up, but it's just not happening when they expected it. They were expecting it to kind of already happen during the second quarter, but now they're saying it probably won't happen until like the third or fourth quarter. So let's look at this next one. The energy sector is getting oversold on a very near-term basis. The sector is due for a short-term bounce at some point over the next couple weeks. And again, pay attention, this was May 17th. On a longer-term basis, we're turning more cautious on this group, XLE. This is not a bearish call, it's a less bullish one. And the reasons are the demand for gasoline and diesel fuel are down year over year, which we expected that, and the recent banking turmoil that apparently is impacting the energy sector too. Something else worth noting is down here at the bottom, it mentions how on the supply side, the Russian crude oil is still finding its way into the international market, despite the sanctions that we, along with other Western nations, put on Russia. It's still getting put out there. We are not saying that investors should dump the energy names. Many of them still pay a very nice dividend yield. So something to keep in mind when you're looking at these. This next one, and maybe we'll just keep going through. So we're in June now. This is June 6th. So oil prices fell. Despite a recent Saudi production cut announcement, demand outlook is still center stage concern. So yeah, OPEC, this is part of the Saudi productions. They announced a cut. We mentioned this in a previous video, so that's still in place. So they're going to cut the supply side, hoping that it kind of balances out the supply and demand, and maybe the prices will even out. Over the weekend, Saudi Arabia said it will slash its oil output by another 1 million barrels per day starting in July. So I don't know if the way it reads, it sounds like this is going to be another cut, but maybe I'm reading that wrong. Maybe it's just 1 million barrels as opposed to, I'd have to look at the other video to see how many total barrels. It might have gone up by 1 million barrels. But continue along. So Russia's basically pumping as much oil as they can to fund their war. And that all kind of tracks here. Saudi Arabia, the world's top oil exporter, is going it alone with a voluntary cut. So again, I think this just really has to do with the demand. There's not as much demand, so they're cutting the supply they're putting out there. It makes sense. The Organization of Petroleum Exporting Countries, otherwise OPEC, and its allies agreed to stick to their production target through 2024. So I guess these cuts overall, long term, based on what they said for through 2024, that's still on track. It's just, I think they overproduced at the beginning. Now they're pulling it back, and overall it should even out. And then it wraps up. I don't think that this Saudi production cut is going to materially change the price of oil. Uh, I guess not. We'll see how it plays out. Again, it's still very early. We just moved into July. That's when the cuts are supposed to happen. We'll see how that affects our gas prices here. This one just mentions how, again, paying attention to the date, June 8th, it notes the Brent crude, a barrel cost about $75, the oil WTI at 71, but OPEC wants it at $80. And so I think this goes along with their cutting. If they cut the supply, it should allow them to push the cost per barrel a little bit up higher to that 80, and that'll give, both sides will be happy potentially. And then this is the last slide for this before we go into the technicals. This kind of dives in a little deeper into one stock that's within the top 10 of this sector, which is Occidental Petroleum. This is one that Warren Buffett just recently picked up in waves. We even touch on a little bit, or at least his name's mentioned here in the middle. But yeah, so let's just dig into it a little bit more. So the energy sector has seen a reversal of fortunes this year, kind of expected. It's down roughly 10% year to date compared to last year, where it was up over 50%. Occidental, which is the focus of this article, pulled back 8% year to date after rising over 100% last year. So it's only natural that it would pull back. Lee Munson, president of Chief Investment Officer of Portfolio Wealth Advisors, sees Oxy, which is Occidental, we're just going to shorten it to Oxy, as a top pick value play. We don't currently follow Oxy, but we follow Berkshire. So in a way, we will kind of keep tabs on it in our own way. But to continue what Munson here is saying, Oxy, they have cheap production, has half of the Permian Basin, which is located in West Texas, which, okay, I actually did pull it. So the Permian Basin is America's easy oil. It's huge, the fields are nice and rich, and it's easy to extract. So if America wants to start pumping more, and they use Oxy in this case, that would be very profitable to the company. I think right now we're not doing that, or it seems like they have high potential. It's just currently it's not being tapped into the way it could be. So we'll see how it plays out over the coming years. And then to wrap it up, investors have pulled back on energy-related stocks this year in favor of technology, communication, and consumer discretionary. We follow those ETFs, and that does seem to be the trend. Price of oil has been on a downward trend this year amid concerns of recession and a weaker than expected recovery in China. Both big concerns. But that wraps this up. If you have any questions or want to add any insight that you came across on your own, feel free to do so, and I'd be happy to read that. Otherwise, let me pull up here. Where is it? So the technicals here, and we'll zoom in. So going back to our spreadsheet here, and I'm just going to pull this off to the side. That way I can kind of just share the numbers. So again, we had it listed at $76 back in 531. So let's just find 531 first, and then we'll kind of play it out from there. So during this green candle right here, that's where we last checked, which would be right around here, the very bottom. It was about 76. That's when we saw it. Since then, it's actually gone up to 81. So that was a slight dip, and it bounced back a little bit. Overall, it does seem to be kind of trending downwards. We're seeing lower peaks, um, not necessarily lower bottoms. It looks like we're finding some support in the mid 70s, mid to high 70s. Um, so we'll see how this plays out in that regard. The buy point that we listed was 61. Looking at that, that was right here, this purple line here, and then resistance of 91, which actually I guess is like 92, which is that red line. So I'm just going to change from 91 to 92, just so I know what the red line is for, just so that matches. So to explain this graph a little bit more, just to explain the different colors and what those are, in case you're new here. So we have, this is the uptrend that I was referring to in our note. So to go back to the note, we said average yearly trend of 3.5. So if we zoom out back to like the very beginning of this ETF, so the graph is going to get small and probably hard to see, but the trend line should still be intact. So if we look at these three trend lines going back to the very beginning down here in the bottom left, all the way through till infinity, we had these three purple lines. If we take what the average rate of return, just taking January 1st of any year for those lines, the average return is 3.5%. So again, nothing, that's not really what we're looking for, in all honesty. Not good enough return in the short term, long term. That said, if we saw this one at a very good buy point, such as the bottom of this purple line, of course I'm going to pick up some, but I'm definitely not going to be making it a big position by any means because of that return rate. But again, if I saw it down here at the bottom of that trend line, yeah, I would probably add in a little share just to say I have some skin in the game, things like that. But again, I wouldn't expect it to be a big return. I just wouldn't. So that's that piece of the note. That's going to stay intact. The second piece was broke short, the shorter term uptrend. And so that brings us to these purple lines here, which I'll make those gold just to separate them. And we can call them out probably a little more easy if we do that too. So make that like a gold or orange. So if we zoom in, that gold trend, we said that started back in November of 2020. It was on this roller coaster ride. It accelerated above for a number of weeks, a couple times actually, and rarely did it dip below until now. So, you know, we can definitely argue that, you know, it's gone above the trend line at one point from March all the way till June. So about 3 months, it actually exceeded it. And here, you know, we're only in May till July. So it's only been like a month and a half that it's been below. Maybe it is gonna just do a very similar pattern where it just dips below for maybe a month longer and then gets back in that uptrend. That's not where my money would lie. I don't think this is going to last. I think it's more likely that we're going to turn into that purple uptrend, which has been more so the trend for this one, again, since the very beginning. I would say normally it's on the upper half, and that's why you put in three purple lines, trending 3.5%. This is representing the long-term uptrend. Generally, it's in that upper half, but as we see, I mean, back in 2002 up till 2005, it was in that lower end, and so that would have been a decent time to pick things up. Then it went back into the middle, even accelerated, pulled back in 2008 to about 2010. It dipped below. Another good time to buy. And so you can just kind of see how this pattern plays out. And another thing I'll point out is every time it's exceeded the upper purple trend line, which again, not very many times, but when it's like really accelerated past it, meaning this point right here, back in like 2008, it really went above and beyond. And then back here in 2014, it really went above and beyond. Both those times when it did it, uh, very soon it came crashing down to the bottom. So here, from June of '08, it took about 6 months to finally reach the bottom, and then it started to build back up. The second time, here in, we'll say July of 14, it took about a couple years actually, but it just slowly trended downwards. So it took about a year and a half to reach the bottom, but ultimately it did reach the bottom. And now here we are today, where again, it's way above the trend line. And if this was truly the peak back in November of 2022, well, we're already at about a 6 months, 7 months, and we haven't hit the bottom yet, but we are trending downwards. So I'm still very, I guess just to jump ahead a little bit, I'm kind of considering shorting this one. Again, I wouldn't do it in any type of aggressive manner, but I think there's potential of this one continuing to fall all the way back to 61, which would be, or not 61, but somewhere in the low 60s, which would be this middle purple line, all the way down to potentially the mid 50s, mid to low 50s. This type of play might not fully reach its potential for another year based on what I'm seeing, but you could see a 25% return, or we could see a 25% return if it plays out as expected. Something that I'm going to consider. Then this box here, we just put that in. That's where I thought it was going to be at this time, end of second quarter. Clearly, I was off by a little bit. If we would have followed it a little more closely, we would have been, better off. But that's where it ended up being. I guess, I don't know if I should leave it where it was, just so I can kind of get a sense of how wrong I was or how right I was. But yeah, I thought it would continue trending downwards. I thought it was going to dip possibly back into that uptrend range. And I still kind of feel that way. Again, based on what I'm hearing, I don't know. I just feel like it's overvalued right now. And so just looking ahead, what I'm thinking this one's going to do come end of third quarter, I think it's going to be in this range. Again, that might be a little aggressive, especially based on how slow it's trickling down. So what I'm going to do is pull it up a little bit. But ultimately, I think it's going to correct at some point. I just want to go back to the last time, the last extreme. How long was this? So about a year it took. And here we are, it's taking, yeah, okay, I'll give this one a little more credit. I'm going to pull this up a little bit more. If it will click on it, am I doing something wrong here? What's happening? Click, click, click. I don't know why it's not clicking on for me. There it is. I'm going to pull it up just a little bit. I'm going to show this one a little more faith than I want to, but I think it'll fall somewhere in this range, 75 to about 72. And even then, I'm not considering buying this one. But let's just update the tracker. So it went from 76, it's now at 81. 5 points for me. I'm going to stay strong at this point and say I'm still going to keep it at 61. 61, 62 would be my spot. resistance at 92. That against the red line. We might actually start pulling this back. Potentially. I'm going to pull it back to 87. I think 87 is going to be resistance. It did seem to kind of find support at 76 in that range, so it might take a little while to pull back. I'm going to update from 92 to 86 though. What I'm also going to do is, so this light blue line that I have in here, I picked that because that seemed to act as resistance for a little bit. There was one point here in August of 22, and I could even argue back here in June of 22, where it passed the line but immediately pulled back within a month, less than a month really, and then it couldn't get above it for about a quarter back here in August, September of 22, and then most recently here we are. It dipped below 81 and now it's kind of struggling to get above it. But what I am going to do is add in a separate line down here, right about in the middle. I'm going to say of around, what is that, 76? It seems like it wants to hang out in this range, and zooming in a little bit closer, you can see it kind of acted as support one time, here's 2 times, and then most recently 3 times it's acted as support, but very small window, 81 to 76. It's kind of bouncing in that range. I think ultimately it's going to sink below over time, but we'll just keep following it and see how it goes. I'm going to update the date till today. So last check, looking at the note, that average yearly return, that is still the same, that 3.5%. Broke the shorter uptrend. I'm going to leave that in for one more lap in terms of these stocks that we're watching, only because we saw it break the uptrend for a couple months, and so if this one continues to play out, I just want to wait one more time to see if that truly is the case. Like, can it accelerate? It definitely could reaccelerate, and so I'll give it one more chance. But after that, I'm going to take it out. I guess I'll leave the yellow uptrend line in. Even after it continues to break, we'll leave it in. The long-term uptrend, I guess what we'll do is broke shorter uptrend. It broke it in May of 23. May of 23. 2023. Whoops. The camera cut out on me just for a minute. So that pretty much wraps this up. All I wanted to do, or what happened since it cut was, I noted the long-term uptrend when that started, which was 1998. I also thought it would be beneficial to put in what appears to be a new short-term trend that's happening. So we added 2 yellow lines in here. I don't believe I showed that before the cut happened. So this is what I think is going to continue playing out, possibly for the next year. I think what could happen is it will dive back into the mid 50s. Not sure if I said this before, so I might repeat myself a little bit, because again, I'm not sure when it exactly cut, but I just drew that in, which kind of is in line with our current third quarter projection of where we think this one's going to end up. But yeah, so just to kind of wrap things up, here's where it is. I don't like this one. I realize we broke this uptrend, and normally during a dip like this, I would be for it. But because of kind of everything that's going on in this one, and the fact that it's way above the purple uptrend, which is it holds priority, That's why I think this one's going to keep pulling back until we get back in that purple range, and that's when I'm more interested in buying. So again, just to wrap this one up, let me pull over the tracker. We noted this one as red, which let me pull this over here. These are what the colors mean. Green is go, so green is buy, red is stop, resistance. Purple is I bought some of this near that date. So for example, here we bought in healthcare around June 25th, and then blue is fair value. I would be okay with buying it or not buying it, depending on if we find other options. But again, just to summarize this one, XLE currently is at 81. I'm still holding firm at 61. In fact, there's a chance. I'm currently thinking of shorting this one because I think there's a decent chance that this one could actually pull back close to 20 to 25% in the next year. Again, if I do pursue that, it's not going to be anything crazy. Maybe just one short share, two, just to kind of just to see, and hopefully we'd circle back to this one in a month, and we can either change our mind, get back out. But just something I'm thinking about. So let me know your thoughts on that. We did drop our resistance point down to 86, and our note here again, average yearly return of 3.5. We noted it broke the shorter uptrend, and in fact, it's actually kind of starting a downtrend. So that might get added in next time if we see this pattern continue. And then of course that long-term uptrend in purple began in 1998. One other thing I want to share is just how this has changed, and what we can do is mark this one red. Hopefully this isn't too difficult to see, but we're going to mark this one red because we think this one is overpriced in terms of the ETF. These are the top holdings in that ETF. I could probably make this a little bit different. But what we're doing here is we're tracking the top 10 holdings. So hopefully that's different on your screen, but these are the top 10 holdings. This was back at the end of May. Here we are at the beginning of July. Nothing's really changed between these. The only thing that was close to noteworthy was ExxonMobil was at 24.1% of the ETF back in May, and now it's at 23.3. So not a wild difference, but it's the biggest swing in the top 10, moving almost 1%. Outside of that, nothing's really changed. I think, again, the idea behind doing what we're doing here with analyzing the individual companies within the ETF is when we can find something like this that we feel confident in that it's going to pull back or it's going to really accelerate in the near future, we seek these holdings, like the top ones in the holding, because if we think something's very extremely overvalued, such as this one, for instance, we can dig into these. And my top choices right now are these ones that I made a darker red. Again, hopefully that's easy to see when we watch this back. But we have Exxon and Chevron, which those two combined make up over 40%. So those are easy candidates. And then the third one I would choose to watch is Occidental, just because we're already going to be kind of tracking it with Berkshire, so it just kind of makes sense. And so again, if we decide to short the ETF because we think it's going to perform badly, we should theoretically dig into these ones too. Exxon, which I know we currently follow, Occidental we kind of, Chevron we don't, but we can add that, and dig into these to see, will it pull back? Because if you remember, if we pull up our PowerPoint slide here, Occidental here, the ETF is down 10%, Oxy's down 8%. So maybe the pullback's not going to be as great as I think it will be, at least not for Oxy, maybe for someone else. But this is really the difference that I'm looking at is the ETF went up about 60%. Oxy, that individual company, went up 120%. So that's what I'm talking about is the ETF can grow at a nice clip, but one of those individual companies can double, if not triple, whatever happens to the ETF. And that's what we're trying to capture here when we believe something is going to really accelerate or really decline. Um, and this one might be one of those cases where I'm going to add a note here just for myself that we're considering shorting this for 20 to 25% from 81 to 61. Yeah, we'll see. I may follow through on that. If you want to chime in on that, please do so. I'd be happy to read that. Otherwise, please like, subscribe, and I'll see you on the next one.